Okay, let's keep it a stack. You already know what they say. Another day, another dollar, another recession, another Fed rate hike. I haven't seen a moment, or I can't even remember a time at this point where the Fed was not raking up interest rates, in order to, slow down the economy and strengthen the power of the dollar and everything like that. You know what I'm saying? And I'm not necessarily saying that's a bad thing, because I don't think it's a bad thing. I think from a textbook economical standpoint, it's kind of what you gotta do. But you already know all the people, all the investors, all the businessmen are going to still look at the Fed and see what's going on, what these interest rates are going to be like, because it pretty much controls how much consumers buy. Are consumers buying houses? Are they buying cars? Businesses, are they going to invest more? Are they going to expand? Are they maybe going to be like, interest rates are a little bit too high, let me maybe wait until a season where they're not as high? But you guys already know what's good. It's NGB Business News, the greatest business commentary news on YouTube. And today we're talking about the Fed and how they just raised interest rates. I'm seeing an article on it and I wanted to check it out, because we like to stay up to date. And I thought you guys would probably be interested in it too. So I'm not going to hold you guys up. Let's go ahead and get into it. Like, comment, subscribe, all of that to help the channel grow. I love you guys and I know you love me too. I feel it. But hey, I'm not going to hold you up. So let's go ahead and get into it, guys. Okay, so it says the Fed minutes show members resolved to keep fighting inflation with rate hikes. Big surprise, guys, right? Big surprise. Not at all. Not at all. Now let's see what's going on. Let's get into the details. Let's get into the nitty gritty. All right, so it says Washington. Okay, you already know Washington, D.C. Federal Reserve officials at their most recent meeting indicated that there are signs inflation is coming down, but not enough to counter the need for more interest rate increases. Meeting minutes released Wednesday showed. This is pretty much exactly what the minutes from the last one pretty much showed. Interest rates are just going to keep going up, guys. They're just going to keep going up. Expect them to keep going up, I would say, until this recession is something that we can no longer talk about, or we can no longer talk about there being a recession, or we can not talk about how bad inflation is. When people are like, yeah, I'm not getting killed, my wallet isn't getting killed, that's when they'll stop with these interest rate hikes. And like I said, interest rate hikes aren't a bad thing. It's textbook economics, So I'm not mad at it. While the January 31st, February 1st meeting concluded with a smaller rate hike than most of those implemented since early 2022, officials stressed that their concern over inflation is high. Inflation remained well above the Fed's 2% target, the minutes stated. That came with labor markets that remained very tight, contributing to continuous upward pressures on wages and prices. As you guys know, a lot of jobs are having to offload their employees, essentially firing or laying them off and everything like that. And at the same time, consumers, while their spending is very high, they're only spending in certain sectors and things like that. For the most part, the reality of it is businesses, their costs are becoming astronomical. Ever since C-19, costs to get materials and things like that has been extremely high. So even though customers are spending a lot, even more, possibly, these businesses are having to spend even more to, meet that demand. And they're getting to a point where the opportunity cost, or not the opportunity cost, the cost of their production is getting to such a point where it's not even worth it for a lot of these businesses and everything like that. So, with the weakness of the dollar, the Fed has to step in, slow the economy down. How do you slow it down? By raising interest rates. Now it says, consequently, the Fed approved a 0.25 percentage point rate increase. That was the smallest hike since the first of this tightening cycle in March 22. So we should note, okay, the Fed's not, they're not raising interest rates at a higher level. They're slowly decreasing, which is actually exactly what we wanted. We knew we needed interest rate hikes, even though no one likes that, in the economy, and we were hoping that the Fed would kind of dwindle it down until, we get out of this recession. And that kind of seems to be what they're doing. So, it's not bad at all. Now it says they approved the smallest hike. The move brought the Fed's fund rate to a target range of 4.5 to 4.75, but the minute said that the reduced pace came with a high level of concern that inflation was still a threat. So there were some people that were sitting at the table clearly in the Federal Reserve meeting, and they were like, I don't think this is enough. That's not necessarily good for our economy, but it's how it is. So I guess really the debate was not if we should raise interest rates. The debate was really about how severe is this recession, you know? Now it says participants noted that inflation data received over the past 3 months showed a welcome reduction in the monthly pace of price increases, but stressed that substantially more evidence of progress across a broader range of prices would be required to be confident that inflation was on a sustained downward path. So like I said, we're still dealing with things like groceries where they just seem to go up and up and up. They don't seem to be really evening out at all. And essentially what it seems to be that they're saying is, yeah, some industries are doing pretty well right now. Some industries are doing a lot better than they were doing in 2022, 2021. But the thing is, the overall general economy isn't where they want to see it. So they're seeing a lot of these sectors that are really still down bad and still getting hurt month after month. And they're saying, hey, we got to look at the overall scope. We're not going to look at, just for right now, like energy is doing very well, but tech is getting smashed. They're pretty much saying we're not going to look at the economy based off of just energy. We're going to look at tech. We're going to look at healthcare. We're going to look at consumer staples. We're going to look at all of that, which is exactly what they should do. Now, it says the summary repeated that members believe ongoing rate hikes will be necessary. Stocks fell following the release of the minutes, while Treasury yields shed most of their losses from earlier in the session. And obviously, as you know, if the Fed comes out and people believe that they're going to raise interest rates, that means the economy is going to slow down. And if you know the economy is going to slow down, why would you invest and put more money into the stock market, which makes you money if the economy is doing better? So obviously it makes sense that the stock market took a little plunge, during the Federal Reserve meetings. I would actually be very interested in seeing when the last time we knew that the Fed was going to raise interest rates and the stock market actually went up. It just doesn't make sense for it. Like, that's just not how it works from a logical standpoint. Now it says the summary repeated that members believe ongoing rate hikes will be necessary. I believe that too as well. Let me know what you guys think about these rate hikes as well. Let me know in the comments. It says stocks fell following the release of the minutes, while Treasury yields shed most of their losses from earlier in the session. Though the quarter point hike received anonymous approval, the minutes noted that not everyone was on board. So this is getting really interesting too, because it used to be like everybody knew, like, hey, from an economical standpoint, we got it. We got to do rate hikes. It's embarrassing. They're going to be coming out here exposing us if we're not raising interest rates when it's textbook, economics that a high schooler could understand. You know what I'm saying? Something like that. But the point that they're starting to debate, the point that kind of tells us that the market's getting a little bit more stabilized, because now it's like, hey, it's up to debate. They're actually having to get these conversations going as opposed to everybody going in, like sitting down. They sit down. Okay, rate hikes, interest rate goes up. Okay, bet. We already knew this was happening. And then they just leave because it's textbook. Now, it says a few members said they wanted a half point or 50 basis point increase that would show even greater resolve to get inflation down. A basis point is equal to 0.01%. Okay. So it says, since the meeting, regional presidents Jane Bullard of St. Louis and Loretta Meister of Cleveland said they were among the group that wanted the more aggressive move. So we're actually getting insight into who exactly did it. James Bullard, Loretta Meister of. It's funny too because these are, I don't know if you guys noticed, but these are kind of like cities that they're a little dangerous. Like, to be honest, they're a little bit dangerous. They're not your utopian cities in America. St. Louis, come on now, Cleveland. Cleveland is what they got. Nah, Cleveland is actually Atlanta, but that's different. But still, Cleveland is not like Cleveland's pretty violent, guys. A lot of gang activity. But anyways, it's just interesting that those people are the ones that are going for these rate hikes. It's something to look into. It's just something to think about. The minutes, however, did not elaborate on how many a few were, nor which Federal Open Market Committee members wanted the half-point increase. Now, there's a quote here from the minutes. If you guys don't know, the minutes are literally them just, typing everything that is said. Now it says, the participants favoring a 50 basis point increase noted that a larger increase would more quickly bring the target range close to the levels they believe and achieve a sufficiently restrictive stance, taking into account their views of the risk of to achieving price stability in such a timely way. Basically, what they mean by this is, we got to get those interest rates as high as possible if we want to get out of this recession as fast as possible. Whereas some other people may have more of a social approach, and they're like, yes, we understand that we need to have interest rates as high as possible, but what are the consequences of that? And the consequences of that is businesses can't expand. Families aren't going to be able to get homes. People aren't going to be able to get cars. People aren't going to be able to create their own businesses because the loans are just going to be more expensive. So I feel like if you want a cheaper rate hike, you're thinking about it more socially. You're thinking about it more democratically. Whereas, you're probably thinking about it on the other side. If you're like, hey, I understand, business is going to be hurt, but, we got to get out of this recession. Which kind of makes it interesting, too, that St. Louis and places like St. Louis and Cleveland, I'm not sure if they're Democratic or Republican, but I do know how their cities work. So I'm assuming that they're possibly Democratic. I'm assuming. This is an assumption. So it's kind of interesting that those types of cities and leaders from those types of cities would actually want the rate increase, and everything like that. But then again, it would also make sense that people like Republicans who are more focused on the business side of it would not be one for doing something that would directly slow down business. So it's a very interesting thing. It's almost like, you can see both sides of it. You can see where everyone's coming from. And I just think, I don't know about you guys, but I think it's just really interesting to think about those possible, I guess, theories you could call them. Now it says, though the summary noted the discussion about larger increases, there was no efforts in the minutes to flag the possibility of stepping back up to a 50 BP pace of hikes, wrote Krishna Guha, head of global policy and central bank strategy at Evercore ISI. Since the meeting, Fed officials have emphasized the need to stay vigilant even while expressing optimism that recent inflation data has been encouraging. Okay. In a CNBC interview Wednesday, Bullard repeated his belief, so he's doubling down, guys, that going higher sooner would be more effective. But even with his push for more aggressive near-term policy, he said he thinks the peak or terminal rate should be around 5.375, about in line with market pricing, which, it kind of makes sense. But like I said, it kind of comes down to like, are you more about the social or are you more about getting out of this recession? Are you more about the people? Are you more about the businesses, the small businesses and the large businesses? In the short term, are you thinking about, we got to get out of this recession ASAP? Those are the two sides that I'm really seeing. Now it says economic data from January showed inflation running at a lower pace than its summer 2022 peak, but still percolating. Percolating? Yeah. Like what is it? Isn't that a dance? Like the percolator? You guys know what I'm talking about? Ha. Now it says the consumer price index rose 0.5% from December and is up 6% from the same point last year. The producer price index, so you guys know consumer, the people who buy, the producer, the people who sell, which measures input costs at a wholesale value, rose 0.7% on the month and 6% annually. Both readings were above Wall Street expectations. The labor market is also hot, indicating that the Fed hikes while hitting the labor market and some other rate-sensitive areas have yet to seep through much of the economy. And now it says, even with comments from Muster and Bullard, market pricing still indicates a strong likelihood of another quarter point increase in March. Oh, wow. Big surprise. Big surprise, guys. Big surprise. Another a quarter point increase. If the rate would land around the midpoint of the target, it would be the highest fund rate since 2001, which actually really does say a lot about the state of the economy and everything like that. Since 2001, do we all remember 2008? You know, I was relatively young in 2008, but even I know it was bad. Now, it says markets are concerned if the Fed moves too quickly, too far, it could tip the economy into a recession. Most of us already consider this a recession, especially if you have to go to the grocery store. You feel me? But yeah, it's true. It's true, though. If the Fed moves too quick with these price rate hikes, businesses won't be able to sustain themselves, which means they will close. And that will cause a recession. Now, it says the minutes noted that some members see the risk of recession as elevated. That's not good. That's definitely not good. Other officials publicly have said they think the Fed can avoid a recession and achieve a soft landing for the economy that sees growth slowing considerably but not contracting, which would be really what we want. That would definitely be what we want. Participants observed that the uncertainty associated with their outlooks for economic activity, the labor market, and inflation was high, the minutes said. Among the risk factors cited were the war in Ukraine. Obviously, that just affects the way the world, is moving. The economic reopening in China, which we've been talking about China a lot, and possibly that the labor market could remain tighter for longer than expected. So I think there's a lot of good things to see here. I mean, obviously, the Fed is going to be raising interest rates. That's not something that interests us. That's not necessarily why I'm talking about this today. That's not necessarily what we're looking about, because anybody with common sense knows that they're going to raise interest rates, because I said it's textbook economics. But what we want to see is, are there disputes going on within the Federal Reserve? How are certain people feeling about it? What do they have to say about the state of the economy? I think it's very interesting that a lot of them say that, the recession could possibly still get worse. But a lot of people are saying the economy is starting to stabilize, inflation is starting to stabilize, and we should kind of wean off of these rate hikes, still have them, but wean off of them a little bit by little, which it seems that we're doing and everything like that. So what do you guys think would be the best move for our economy? What do you guys think? Do you guys think it's more on that social side where it's like, hey, we need to keep these rate hikes kind of low so people can start businesses, get cars, get homes, businesses can expand, and, eventually later be able to really, make money and stimulate the economy? Or should the recession really be the main focus? We raise interest rates to, possibly astronomical levels, with it being that since 2001, you know what I'm saying, and everything like that. And, possibly we can get out of this recession. And then after we're out of the recession, then we can start talking about, everything else after we get out of this situation that we found ourselves in. So I'm really interested to see what you guys think about this. I want to see what side you guys are. I'm very curious and everything like that. Also, of course, like, comment, subscribe if you like this kind of business commentary. Just kind of sit here, relax with the guys and the gals too. We didn't forget about you. And we just have a good time and we talk business so we can be informed. You guys can make your stock picks while being well informed and not ignorant. And basically, we can really know what's going on in this world, because if you're ignorant, people are going to take advantage of you. And I don't want you to be taken advantage of. So I hope you guys all have a great day. Be blessed. And just know interest rates are still going up. So it is what it is.